Okay, I think we're good. So good morning, good afternoon, and good day, wherever you are in the world. My name is Craig Murray, and I am joined here by Simon Putt and Christopher Williams. We are financial advisors. We've worked in many countries around the world, and we have a total of about 40 plus years of experience between us all. So during our many roles around the place, we have realized that a lot of questions that clients have are very similar, regardless where they are. So we decided to put this together to really answer the common questions and the common concerns that clients do have with regards to finance. If you do have any questions, please send them in or add them in any comment section below. Please like, please share, please subscribe. And we look forward to helping you through the future. So good morning, guys. How are you?
Very well. How are you?
Living the dream. It is bright and early here in Las Vegas, on the almost on the West Coast, in our new office here, which is looking lovely. Thanks for joining me. I'm hoping that this is going to be really productive. I think it's going to be really helpful for a lot of people. So let's kind of get started. For those that are new to this, as we are, what we are looking to do is really just have a conversation about what's happening in the world and try and answer questions for you guys at the same time. So this show is really going to be about the client's biggest concerns in 2020. So there's a lot going on this year. There's a lot to cover. We don't want to go on for too long, so we may split it up into lots of little podcasts. So we'll start from now. And really just see where it's going. So what do you guys think is the biggest concern in 2020 right now in the client's minds?
Well, I would say thank you, Craig, first of all, and good day to you both. I would say that no surprise so far in 2020, most of the questions I've been receiving from investors, from savers, have revolved around COVID-19 and the global pandemic itself, and then obviously its impact on global economies and, as a consequence, markets. And we don't expect that to go away anytime soon in terms of being a prime focus for clients. I would say the nature of inquiries has changed throughout the course of the year. Back in March, when we were in the height of the crisis in terms of markets plummeting, we had the sharpest bear market in history, and obviously a lot of concern from clients about where's this going, when does it stop? But then conversely, we've then had one of the strongest market recoveries in history over the ensuing 5 months. Questions were then more about, well, how long does this go on for? Are we going to peak out at some point? Should we be worrying about a W-shaped market recovery as opposed to this V-shaped recovery? And I guess that hasn't really gone away, particularly as markets have begun to dip again in the last month. I would say by and large, investors have sat tight, but this doesn't stop their questions coming. And I guess in terms of where we go from now, I guess questions will continue to revolve around the resumption, a second wave of the crisis, the severity of any impact on the economy globally, and any good news around a vaccine that could prompt some market reaction. So that's going to, I think, remain a prime point of investor inquiry over the next few weeks and months.
No, I completely agree. And each country is kind of handling it differently as well. So obviously today or yesterday, if anybody wonders out there, it is September 24th today. But yesterday, the UK put in a few new rules and regulations, so people have to now go back to 6 people only, and they're stopping the pubs from opening later and things like that. So I think every country is kind of handling it slightly differently. Is that having an different effect over there to the economy than it is over here and in Europe, do you think?
You could say so, although I would suggest that for markets globally, one thing that has changed compared with where we were in March is that the world feels like a very different place in terms of how it deals with coronavirus. I mean, back in March, we were entering a real black hole of uncertainty. How deep is this pandemic going to be? We had total global economic shutdown. In March, it was very difficult to see a way out of that and where we went from there. Even if we have a second wave in the virus, and even if we enter some kind of lockdown scenario again, I guess the things that have changed since March, first of all, governments have shown that they can get on top of the virus. That it can be contained. It is manageable, even if the cases are going up again now. It does look containable, possibly. The second thing is that governments have really stepped up to the plate, and that wasn't apparent back in March. And governments have really made it clear that they will do whatever it takes to get economies onto their feet again.
Yeah.
And then the third thing is, and probably this was quicker than people expected, economies began to reopen again. Now, okay, it might be step by step, and it might be one case of 2 steps forward, 1 step back, but economies are beginning to move again. So, even if we enter another dire situation now, at least it doesn't look as dire as it did in March. And I think investor inquiries will be sort of tempered by where we are now compared with where we were in March.
Yeah. No, I agree with that.
Speaking of the long-term impact, Simon, you and I were both in London, weren't we? I think last month, sort of in the business district, and we both commented how quieter it was in terms of restaurants, in terms of, you see a lot of the banks now asking people to stay home long term. Are there now questions raising, do we need these massive expensive buildings in the heart of the city? Do you think there could be like a long-term impact on the way we do business in both the financial sector and the larger business as a whole? Do we need these big central city elements the way we used to?
Well, that's another issue. Yeah, I mean, it's certainly we've seen investor business behavior change. Obviously, tech has come to the fore. The fact that the three of us are talking to each other and talking to the world via Zoom without sitting in the same room as each other, this became our modus operandi for getting things done. And I think probably from a lot of companies' point of view, whatever sector they're in, it has shown to them that they can continue to operate in some shape or form. Maybe they don't need all these fancy acreages of office space that they've had in gleaming towers before. And business travel as well. I mean, as if the airline sector needed any other bad news, suddenly maybe we don't need to fly to see our counterparts in Moscow or Tokyo or wherever. We can do it all like this.
I completely agree. I was flying 2-3 times a month to see clients around the US, and I haven't been on a plane since February now, for work anyway. And everything's still ticked along as normal. So I think you're right. Yeah, things are just going to adapt.
Yeah, no, I mean, on face value, that's not great news for certain sectors. Building, construction, real estate, airlines, as we've just been suggesting. But yeah, at the same time, companies have got to keep themselves afloat and watch their bottom line. And if there's means of cutting costs in terms of office space or numbers of people, well, we're already seeing it happen, and we would expect that to continue to happen, which will then obviously affect markets in terms of how companies are able to perform. But we're clearly, we are going through a period of adjustment as the global economy gets itself back onto its feet.
Yeah, and I think another big factor, just to kind of move on from the COVID point, is the elections that are coming up right now. The US elections, obviously in November, are a huge factor over here, and I think everywhere around, which are having an effect on the market. And I think mainly just for uncertainty. Over the years, if you look at the research, the years leading up to a presidential election, the markets are just slightly quieter. They're not normally as volatile as they are this year, but because of COVID and everything else added to it, and I think this year is an even bigger election than the last one, because you've got such a big divide right now in the US that that's what's sort of spurring a lot of the volatility. I think personally, one of the biggest factors when it comes down to the markets, and what I've been telling a lot of my clients with regards to the election, is that it doesn't really matter who wins, whether it's going to be the Democrats or the Republican. It honestly isn't going to matter too much. The markets have already priced in the election. What you need to be looking at, though, is the policies of each party. That's what's going to have an effect on the markets, and probably more so the House, if that's whoever's sort of running the House, because they will make the decisions on a lot of trade policies, and the trade policies, I think, are going to have effect on the markets as well. So really not to sort of concentrate too much on the presidential election, because though what happens in the presidential election is more sectors might be affected, healthcare and trade and things like that. But the House election this year that's actually going on as well will have a bigger impact, I think, on whether we go up or down in the long.
Did you find that investors worry about the election, or are they just curious as to how it's all going to work out? I mean, are they legitimate? Do they have particular concerns over one outcome over another?
I do think so, especially with the divide there is right now. You're either left or you're right over here, and there's no kind of middle ground when it comes to what the media is trying to say. So a lot of people are very concerned if Trump wins, what's going to happen to the economy? If Biden gets it, what's going to happen to the economy? What's he going to do? What things is he going to put into place that will change and affect us on the ground and affect our economy? Nothing ultimately, immediately that they do is going to knock on it and affect the economy over here. And I think it's already priced in. And the last time we spoke with, I think it was Optimus Capital, they were saying that the markets have already priced in the election, regardless who wins. It should be, from a volatility standpoint from the elections, it should be relatively steady. Now, that being said, everything else that you factor into the world right now, that's what's kind of causing the volatility. But clients are concerned, but there's no real need to be concerned, if you see what I'm saying.
You do often see a surge, don't you, in election year? You normally see the USD go up a little bit, and you often see kind of confidence in market even before we have a clear idea what side would win. And so from that point going forward, is this the best time to be speaking to your clients about opportunities? Right now is certainly a good time. Not necessarily, I think, about looking at opportunities. I would say from a portfolio standpoint, have something that is stable. You're looking for the future. You're looking for a business cycle, and a business cycle is a lot longer than a presidential cycle. So a business cycle might be sort of 10 years, 20 years. And that's what you're investing for. You're investing for the future. A lot of our clients were dealing with pension money and things like that. So we're not looking at trying to make the quick buck and trying to get that 10% growth today. What we're looking at is a lot further down the line. And I think as long as you as an investor or as a client understands that whatever's happening right now, the turmoil and the volatility right now might be concerning, but in 10 years' time, and you look back, we're going to be in a better position. If you look at the historic data from 1920s or 1900s all the way through different presidents and different parties running the country, it still is positive. And that's the way to look at it, is don't worry about it right now. Look at what you're investing for. What is your goal? If it's 5 years, 10 years, 20 years, that's what you should be targeting. And that's what I'm telling my clients. That long term, because we say markets have been good for so long, which is true, but we forget we've had shaky periods. We've had the end of 2018, haven't we, with trade wars. We've had post-Brexit, 2008. Obviously, 08 being the big one. So we just keep going on to the dawn of time. But exactly, so I certainly will sort of touch upon that a little bit. That importance of sometimes tuning out the noise. Yeah. I think it's sensationalist in a way, isn't it? You could doggedly check Bloomberg, 20 times a day, and to see what's going on. But I sort of think that's very counterproductive. For sure. There's certainly certain things that are affecting the markets more widely. China, for example, there's so much happening with that kind of conflict and pushback. I do not think that as well as having a factor on things. Well, I did want to bring that up because if we're talking about concerns that investors have got in 2020, and Chris just mentioned it very briefly, then I would bring up the trade war with China, and it dovetails to the politics that you're talking about there, Craig. And I think if COVID-19 wasn't around this year, the trade war and the tensions with China, between China and the US, would be probably the foremost concern for investors, just as it was in 2019 and 2018. It's been pushed to the background at the moment. You'd expect that, what with COVID going on and governments rightly being more focused on dealing with that than the geopolitical factor. But I would expect that that's something that's going to continue to rumble away. Even if we are able to put COVID behind us, you'd expect the trade tensions to be something that will continue to resonate for markets, and maybe even
the outcome of the presidential election has a bearing. I mean, one can't predict, but one would expect, a Trump administration to continue to be more bellicose in its rhetoric than a Biden administration. But I do think that's actually the longer term concern for markets and investors. I mean, let's hope, God willing, we get through COVID, they find a vaccine, and the world can relatively get back to normal. But that trade tension, I think, is still going to be there, and I think that's going to be the one thing. Whether we get good news because of developments, agreements, or bad news because they start shouting at each other again, that's going to remain a big theme for markets, and something that people will still be asking about.
Wholeheartedly agree with that. I think the trade policies are going to be the biggest thing in this election to have an effect. And it will depend on who comes through, who wins the White House, and who wins the House of Representatives, who wins that, because they make the decisions. They're the ones that sign off the trade agreements. So that's what I'm going to be watching throughout this whole process.
Fascinating to think where the world could be 10 years from now, isn't it?
Yeah.
So we always have this tendency, I think, as humans, to always slightly look back instead of forward. But if you look at what China's doing in Shenzhen, and what is there's technology, and obviously China now being that dominant economy, or very soon, and then Asia taking over. I think it's such a fascinating conversation. I could stay in here all day talking about what do you think in 20 years, what that's going to look like, and also like where we are now, but putting into context where we are now in how history will remember it. Like obviously,
and have a look at where we were 10 years ago.
And that's the thing. From a technology standpoint, 20 years ago we had Nokia 3210s and all that kind of thing. Now my phone is significantly better. But again, where we're going to be again in 20 years. And a lot of times where we kind of, maybe to bring, how's history going to remember 2020? Probably with not a great deal of fondness, but what a trade war could mean if that spurs China on to want to become more nationalistic, create more for themselves, what that push could look like. And all these small points in history where things can hinge. I sort of think I always like to imagine where we are in the context of history a little bit.
I think it's such a fascinating question. I mean, I read a report not that long ago written by a prominent global bank, which was arguing that by the year 2030, 8 of the 10 biggest economies in the world would be what we call emerging market.
Really?
China, India, Brazil, Indonesia was in there. I think Egypt was in there as well. So, there is clearly a global shift that's going on. Whether the events of 2020 have derailed that or slowed down the process, time will only tell.
It changed it for sure. I think the world has taken a sharp turn, for good or for bad. Time will tell. But I think this has definitely been the year that has put us on the trajectory, or a different trajectory, in a different direction to what we were maybe heading. Certainly a more technical or technology heavy one. And maybe, who knows, maybe for the good. I'm certainly excited to see where we go from now.
If we think more standard market movers and shakers, I mean, at the moment, we've been talking about very legitimate investor concerns about geopolitics, obviously about the pandemic. If we stripped all that very headline catching stuff out of the conversation, I mean, where do you see some of the more sort of standard market movers? Something I get asked about inflation, for example. I personally, I think right now there's not a lot of people going out and spending money, especially because of COVID, and people spending money is what pushes inflation up. So right now we're around 0.4%, I think, over here. It's very, very low. Interest rates, the Fed have just come out and said they're not going to move them for the next 3 years. So, that's not going to push anything up either. So until I think COVID is under some sort of control, or we have some sort of vaccine, and people start to feel safe again to go outside and start living their lives again and start spending money in the shops and the communities and whatever else. Until that happens, I think inflation is going to stay relatively low. Once it does, their target is 2%. And that's where they want to get to, full employment and 2%. Now, whenever that happens, what they will end up doing is they'll increase over 2% to start with, just to even it out over time, so the average is 2%. So once everybody starts getting back to normal, you'll see inflation increase quite drastically, I think, and then it'll level out in time. But
I think we're good right now. The cost of living is going to stay low for the foreseeable future until we get some clarity and some confirmation on COVID. That's my opinion. Hopefully you guys agree, or
I mean, we've been lucky for a long time. They call it a Goldilocks scenario, isn't it? In sort of the 2010s, we kind of had low inflation, high growth, and it's been so rosy for so long. A lot of people, I think, are very keen to always be quite negative to say, I think, since 2017, people were saying this is the year the markets collapsed. 2018, this is the year markets collapsed, and all that kind of thing. I guess it all comes down, I think, in the ways to consumer confidence.
yes,
So right now, and what's going to get people to go out there spending again? Is it that scary point where the economy slows even further because it's kind of a self-fulfilling prophecy? We could speculate, and we could say until a cure is found, until I honestly think until there's more clarification, we can't know for certain. And there is still that, I believe, that cloud of uncertainty above us, and things like inflation, we just won't have a clear idea yet.
Yeah, I do tend to agree. It's a little bit down the road, given what's happened this year, and it's inevitable at some point. And investors, if they are concerned about inflation, well, there are things that they can do within their portfolios to embrace inflation and treat it as their friend. Some of the counter-cyclical assets that they can bring into play, more commodity-based or real estate-based. Maybe it's not the time yet, but certainly there are things that can be done if inflation does become a concern for investors.
Yeah, there's certain tools out there that you can use within your portfolios and just sort of speak to your advisors, and they'll be able to guide you on how to get around it.
It's certainly the most impactful period we've had since the obvious in 08, 09, isn't it? And that kind of thing. But there have been market events. There's been Brexit. There's been a Trump election. There's been obviously escalating trade wars in 2018. So it's not the only thing, but it's certainly probably the most significant thing. But it's funny, isn't it? It's funny. It's always doom and gloom, and it's all over the news how terrible everything is. But you've seen the S&P hit a new high.
Yes.
I think last month we saw gold hit a new high as well. So you would tentatively say, arguably, is there more opportunity with this added volatility now, with a new story, than perhaps there have been for the last few years when it's just been an upward bull market and equity markets year on year have seen that growth? There's probably a great argument either way, but it's certainly probably a lot more interesting than it's been the last few years.
Yeah, there's been a lot of good buying opportunities for sure. But this year alone, I mean, I'm sure a lot of people, when markets dropped in March, a lot of people ran away and were scared. But what Warren Buffett says: when others are fearful, be greedy.
Be fearful.
Yeah, so
blood in the streets and all those horrible
exactly.
But I think one of the things that changes for a lot of investors is, okay, some of the people that we talk to have been in the game for a long time and have seen cycles come and go. But equally, a lot of people have joined in within the last 10 years and, until this year had seen nothing but markets rising. And sometimes I'm interested in the views that I get sort of asked about, how much further can markets go? I mean,
and that's it. Yeah. When do we see that? What do we see happening? Do we see that dropping off and dropping back? I don't. We're going to see volatility, right? But theoretically, it's always going to continue to grow. We might have a couple of years of negativity, and then we'll get better after that. I always look at the historical graphs going back however many years, and things always look.
Which I know that's something Sid will touch upon maybe a little bit way down the road about sort of investing for the long term and what compound interest really means for you. But I sometimes think take a step back. In fact, when I speak to a lot of my clients, I wouldn't want to be drudging up day by day news because it's not really the point. Mm-hmm. I think certainly for what we do, it's not the point. It's an interesting time for us now to be kind of that reassuring hand a little bit more. And I'd always encourage that long-term view. If you're investing for 20 years and you want to get to a point where you've got enough money for financial freedom, that's 20 years. This is 1 year of 20.
Yeah.
And, it's whether or not there's an argument, it's great to invest when there's volatility or we shouldn't. I sort of think that's just one part of the conversation. It's really your own strategy. How is this relevant for you and what you're investing for a little bit. And I'd always encourage people to keep the big picture in mind, because it's so easy to get caught up in the noise and the day-to-day And it can derail things, and you can lose confidence in your strategy when perhaps vesting through market cycles, in market cycles every 7 years or what have you. This is just one part of that plan. This is just one part of that stage.
That's the best way to put it.
Yeah.
It's just a small part.
Yeah, that strategy, you talk about strategy there, Chris, that's such an important thing. And that's what I was countering a lot of concerns with, that, while markets were gyrating, while headlines were dramatic, the simple question that you put back to investors is, well, has your long-term strategy changed? By long-term, I mean people, planning for retirement in 20 to 30 years time or something like that, or a university education that's 15 years away. Fundamentally, has your long-term strategy changed? And even if the markets have changed today or in the course of a week, well, did your strategy change? And if the answer is no, then, well, don't change your strategy. Don't change what you're doing.
That is a great point, that regardless of what's happening, is your portfolio should be for that long term or for that goal, whatever it is, 5 years, 10 years, however many years it is. But your portfolio should be built to withstand individual volatility that happens like it is happening this year.
And I get it. I do get it. It's quite full of anxiety to look at your portfolio and you've seen a significant drop, especially when this is a lot of your money. Of course, you're going to be worried. Everyone would be. But again, this is exactly part of that process. Like market cycles, you're in a different phase of it now. There's advantages to be taken in every phase, and this is just another one. I feel, as an advisor, I'm not sure you do, like my job changes a little bit now. It's in the 2010s, it was fairly good. It was fairly good to be in equity markets. Now, I get to be that reassuring hand a little bit more. I get to sort of relay to them what investing long-term really means, and having that courage to stick it out.
Yeah, I agree. And what would you say, if clients were to come to you and say, is now the right time to be invested? What's your answer to that? Because obviously a lot of people are concerned. I've got clients myself now that are sitting in cash waiting because the market is so uncertain. What's your advice to clients now?
Okay, so it all comes down to time horizon. That's always where I start. Every time I meet with someone, once we've got a coffee in, is to talk about time horizon. So like, so you want to invest for the next 20 years? Or do you want to invest for the next 5 years? If this is a long-term thing we're doing, if this is a strategy, so you can have as much money as you possibly want down the road, it is a good time to be going in many ways, because markets are lower. I mean, you can buy in at a better price. Well, all that's true. I tend not to get caught up in that rhetoric and all those cliches about the best time to go in or the worst time to go in, because you would kick that can down the road all the way until it's too late. So I totally agree. It's a great time to go in when there is that volatility. But what are we investing for? What's the point? What are the goals? Put your goals over the market noise, because the Bloomberg and BBC News, they don't care about you. They care about producing news. You should be concerned about is building your own strategy.
Yeah.
And I look forward to having that conversation more as volatility goes. And I look forward to being to add that value a little bit as we enter this whole new phase.
Totally agree. Totally agree. And I think having an open conversation with clients and helping them understand, don't go silent in these times. If you're not hearing from your financial professional when things are like this, then you're probably with the wrong financial professional. You should always be having conversations. Volatility is not a bad thing. Negativity is not a bad thing necessarily. As Chris said, look at the reason that you're investing, and base it on that, not base it on what's happening on the Facebook or on the news or whatever else you get, however you get your media. Please
don't read some article about how gold is the best thing to be in during a crisis and cash out of all those equity funds when you've seen that downswing go into gold and then not benefit from the upswing. Yeah. It's weird how human nature is some way counterproductive to the best way to make money doing this. In that sense, please do not sell out when things are lower. It's the last thing you should be doing. Just hold fast.
Yeah, I refer us back to the chart that Craig mentioned earlier that shows equity market history since the 1920s. It couldn't be any clearer. Yeah. Sure, there are bumps and troughs along the way, but the long-term trend is your friend. It couldn't be any clearer about the value of sticking in the markets. Time in the markets, not timing the markets. That's what we always say. Perfect. And on that note, honestly,
a little bit now goes a long way.
Yeah.
A little bit now goes a long way.
Well, I think we can bring this one to an end. I don't want to go on for too long because we want people to find it interesting and listen. So thank you everybody for listening.
Thank you, Chris. Thank you, Simon, for jumping on. We will be doing this regularly, so that was really good. I hope you found it interesting. If you have, please like, please share, please tag one of your friends in that might find it useful. If you've got any questions, pop them in. There'll be an email address down here that you can send it through to. And hopefully you found this really useful. But thanks for joining us, and we'll see you again soon.
Pleasure. Thank you, guys. Thank you.
Take care.
See ya.